How do I invest? From a CFP's perspective, investing is a good thing to do. It can provide income, growth, and some inflation protection. But how do you start? And what should you invest in? In this video, we'll talk about some of the basics of investing so that if you're thinking about putting your money somewhere other than under your mattress, you know where to start. Having a financial plan. Having a financial plan is an important thing for all of us. A financial plan is a document or guide that helps you to make informed decisions about your money and how you will use it in the future. It's really based on the person's specific needs, goals, and values. Now, as most things in life, having a game plan helps when it comes to investing. We'll walk you through what to do if you are just starting out as an investor or if you already have some investments but want to get more out of them. Now, when you're starting out as an investor, the first thing you should do is set up a financial plan. This will help you figure out how much money you need to save, either monthly or annually, and how long it will take to reach your financial goals. Now, after you've figured out this savings goal, or at least a percentage of your income you'd like to target towards savings, you might be ready to start putting this into action. Now, generally, when people think of investing, they think of the stock market. The stock market can be a volatile place. It's a fact of life. You can try and avoid it, but you won't succeed. Volatility is not always bad. Indeed, some people use volatility to their advantage. For example, if you invest in the stock market long enough and have an eye for price patterns, let's say, then you can make money by buying at low points in the market and selling at high points in the market. This same principle applies when investing in bonds or other fixed income instruments. Buying low risk bonds when interest rates are low and selling them when interest rates go up will increase your return over time, and vice versa. Now, these sort of trading strategies can work well for someone who knows what they're doing and has no emotional attachment to their investments. But be warned that these tactics carry risks too. There are many things that affect how volatile investment returns are from year to year, such as inflation, interest rates, which is the yield on bonds, politics, and those things all change over time. Now, if you're hoping for consistent increases over time, that maybe the stock market isn't for you at this point. Perhaps further education on the range of expected returns or investment outcomes for each investment you are considering is the best place to start. That way you can begin to gauge your comfort level and how you feel about putting your money to work. This leads us into our next question to consider, and that is, what type of investor are you? Now, all investors have different risk tolerance levels, portfolio sizes, time horizons, and income needs. And if your income needs or savings goal can be met with an aggressive portfolio, then that's great news. But if your income needs require a more conservative portfolio and approach, you'll need to make some changes in order for the investment allocation strategy you have to work best for you and your comfort level. Now, this comfort level is called your risk tolerance. A risk tolerance is your tolerance for losses that statistically will happen given each type of investment you're in. Now, if your investments don't go up in value, they won't help you very well achieve your financial goals. And if they do lose money and stay down for too long, it could affect other aspects of your life, such as your stress or health. So there's more to risk than just loss of principal investment, and also the impact to your emotional or mental well-being. Now, in addition to figuring out your risk level and what type of investor you are, there are a few basic questions that you should ask yourself before investing, and that involves choosing the right investments. What kind of investments am I looking for? Well, you can choose between stocks or bonds, or a combination of both, and various other market and non-market investments. Some people prefer to invest only in safe assets like cash or certain kinds of bonds because they want their money to be readily available or they are income focused. Others want higher returns on their investments, so they're willing to take more risk and invest in the stock market, where there is more fluctuation with ups and downs in price, but also greater potential gains when the market goes up over time. Now, in any case, try and match the type of investments with the goals for your investments in addition to your risk tolerance. This next point is something that you're probably already doing, and that's invest systematically. The best way to invest is to do it systematically, meaning regularly and consistently over time. Now, over the last several decades, the S&P 500, the index that includes the 500 most valuable companies in America, has returned about 10% a year on average, before fees. Now, if you're saving for retirement or another goal, investing $100 per month over 40 years will result in almost 5 times as much at retirement than if you only invested once per year. Now, this is because of the frequency of getting money to work for you over time and allows for more frequent compounding. Hence why company-sponsored retirement plans that have automatic payroll deduction have the greatest success of growing your wealth as compared with most other non-systemized plans. The last point is start early and stay disciplined. It also helps if you start really early instead of waiting until later when life stacks on different bills, things get more complicated, and responsibilities pile up. Now, starting earlier gives your money more time to grow, which makes a big difference down the road when it comes time to start unwinding your income from your investments. Also, contribute enough, but not too much of your paycheck every month so that it doesn't feel like an impossible burden, but still leaves enough room in your budget for things like a mortgage payment, life insurance premiums, maybe beer money, or family vacation plans. This allows the psychological side of investing to not feel so burdensome that you fail to stick with the plan. And lastly, be warned. It's important for you to understand the basics, and with that, realize that investing is not a get-rich-quick scheme, but it can help you build wealth over time if you have the right plan in place and stick with it. Stay away from the hot stock tips or things that seem too gimmicky with little history or track record. Also, a good rule of thumb is if you can't explain an investment or understand it, then you might want to think twice about incorporating it until you have a better handle on it. To conclude, investing can be a fun and exciting topic as well as rewarding if you follow a plan and do things right. If having a plan seems too complicated for you as an individual investor or just plain stressful, consider working with a financial advisor who can do some of the heavy lifting for you. Investing is a complex topic, but if you take time to think about your goals, set up a budget, and work with an advisor that you trust, then you can make the most of your money. Thanks again for joining us today. If you found this insightful, please share with someone you care about, and hit the button down below before you go. As always, keep doing life better, and we'll see you next time.